welcome. You're watching SBI Mutual Fund presents Invest Smart Mutual Fund Ke Sath, partnered by ET Now. I am Kavita Thapliyal, and today we are going to talk about hybrid mutual fund. Now, as a category, we all know hybrid mutual fund invest into equity, debt, and other asset classes. There are equity-oriented hybrid mutual funds, debt mutual funds, balance category. We also have arbitrage. But then, what exactly is for you? How can you, as an investor, identify what kind of a hybrid fund is suitable for you and your financial goals? So that's going to be the topic of discussion for today's show. And with me on the panel are Mansi Sajeja, Deputy VP Research, SBI Mutual Fund; Gaurav Mehta, CIO Alternatives, SBI Mutual Fund; Vishal Dhawan, CEO, Founder, Plan Ahead Wealth Advisors. Hi and welcome to the show. Mansi, first question to you. Looking at the category hybrid, and there are different types of hybrid mutual funds. Let's just jot this down for an investor. Let's give them a framework of hybrid mutual funds in terms of categories. What kind of categories would you want to highlight? Which investors can go for as far as the portfolio planning is concerned, and how many hybrid funds are we talking about?
So, Kavita, as you said, that hybrid mutual funds means that there is more than one asset class that is held in one scheme. Typically, it is equity or debt, and sometimes there is commodities as well. Right. And gold being the most common commodity that mutual funds hold today. In terms of categories, SEBI has broken them down into broadly 6 categories, starting with, say, the conservative hybrid, equity savings, arbitrage, then there are multi-asset allocation. There is something which is very popular called the balanced advantage funds, and then the aggressive hybrid category. And each of the fund houses can practically offer only one fund in each category, so it makes it easier for the investor to decide that which fund offers which category in
a fund, right. But then let's deep dive more into this, Gaurav. So let's talk about the asset allocation for these categories. Now, talking about the balanced category, conservative and aggressive hybrid category. What exactly goes in the asset allocation in terms of how much in equity, how much in debt, and other asset classes, if at all, involved?
I think the interesting aspect about asset allocation is that there is no one-size-fits-all approach, right? Every individual is different in terms of risk, return, expectations, and so on. And I think which is where it's interesting that the hybrid fund category can itself be divided into 3 broader categories.
Okay.
The first one is where you have static asset allocation. For example, the conservative hybrid category, for example, will have about 25% exposure to equities and 75% to debt. So it's very conservative.
So where they invest in debt part?
So the debt part can in turn be invested either in government bonds, in credit, and people can take credit. The fund manager can take a credit call there, a duration call there, and so on. So that's a separate aspect. But from an asset allocation point of view, it's 25% equity, 75% debt. Then the other end of the spectrum is obviously equity hybrid, which is more aggressive. 75, closer to 65% in equities and more like 35% in debt. So it's a little more aggressive.
And the fund manager is free to move between large cap, mid cap, and small cap.
Absolutely. So that's a second layer which comes through, and there is a third layer on security selection as well. But from an asset allocation point of view, it tends to be a little more aggressive because there is high allocation to equities. And these usually are categories where investors should think of whether they are a high risk investor, a low risk investor, and accordingly choose between some of these static categories. But beyond this static asset allocation categories, the next extension is what you call solution oriented funds. For example, there are retirement benefit funds, there are children benefit funds, where you in a way the fund is associating your asset allocation to a certain goal which will materialize and for which you need money after a certain time period.
Okay.
So it's a logical extension to a typical hybrid fund. And then the third category is where you dynamically allocate, right? So there the fund manager basis whatever frameworks that they use may decide when to be significantly overweight equities depending on circumstances, when to be significantly overweight debt, and in a way sort of has the flexibility to move around. So I think again depending on which kind of investor you are, you could choose either one of those 3 or have a combination of the 3.
Talking about the kind of hybrid category that's in trend these days, I think till almost last year, we saw the balanced category doing extremely well. But now if you look at the returns, I think the multi-asset allocation funds are like giving good returns, and even the investor interest has gone high over there. What could be the reason behind it?
So I think there are 2 drivers for this. If you go back to a year ago, equities as an asset class, especially domestic equities, were outperforming all other asset classes. And clearly the balanced advantage funds, depending on the model that they ran, had the ability to go a little more towards equity, or if you were running an aggressive hybrid fund, then by default equity allocations were 65 to 80% in all of those funds.
Right.
So clearly equity performance dictated the performance of the category as well. What has happened in the last 12 months is, interestingly, an asset class like gold, for example, has actually been your best performing asset class, partly because gold has done well, but the other part has come from the rupee depreciation as well. And that's moved the prices of gold up. And therefore, any product that has some exposure to gold, and obviously multi-asset funds have at least 10%, if not more, have actually gained through this process. Also, debt as an asset class, even though there has been a mark-to-market impact because interest rates have gone up, has actually done reasonably well as compared to equities. So the more debt and the more commodity exposure you've had, the better off you've actually done as compared to 1 year back where the more equity you had, you did better.
Okay, so now for someone who is just thinking of starting their investing journey, do you think hybrid as a category can be the first category to enter equity markets through mutual funds?
The short answer is yes, that you could look at to start your investment journey through a hybrid fund.
Okay.
As Gaurav said, and as we discussed, decide your asset allocation first. So that is based on your individual goal. But then once you have decided an asset allocation, then what does a hybrid do? That it automatically reallocates your money based on the movement in each asset class, which you may miss out or you may not do it diligently. The other aspect is that whenever you're thinking of savings, we forget the inflation-adjusted return bit of it.
Absolutely, yeah.
So even in a conservative hybrid, which has 75% debt, an investor gets some equity participation, which allows them over a longer holding period to beat inflation. So yes, you should look at hybrids as a stepping stone into your investments and as also a core part of your allocation.
All right. But then talking about return expectation, now if you pick up the data, I mean, you would know more than me. Last 3 years, certain category of hybrid mutual funds have given superb returns, okay? And also we just discussed with Vishal, the multi-asset allocation currently is doing really well. But then the categories you mentioned earlier, if I have to have like an approximate return expectation, what would that be?
So, I mean, eventually it will depend on what of those categories, which fund are you choosing. If you're on the conservative side, you're looking at debt plus returns.
Right.
On your aggressive side, you're looking like equity-like returns. But I think on balance, the important aspect here is that there are certain advantages that come through, beyond those return numbers per se, which is that when you're combining different assets together, it brings in a degree of diversification. So we saw that 2003 to 8 period where equities did very well in India, but bonds didn't. 2008, suddenly equities crashed, but bonds did very well because interest rates were cut to revive the economy and so on. So I think once you combine these assets in whatever proportion you do, you get some diversification benefits. And they also say that in finance there is only one free lunch, which is diversification. So wherein you can improve your risk reward without doing anything else, just combining different assets together. Right. So I think that's one big advantage. The other, related advantage is that when you think of drawdowns, right? When I'm going to need that money, will that money still be there, or will the markets be down and up? I think that drawdowns also, because of this diversification impact, get mitigated in a hybrid fund. And then the third advantage, which let's say something like a balanced advantage fund can bring in, is that within that asset mix also, it tries to, I won't use the word market timing, but it tries to use a framework to decide when is it a good time to be more overweight on equities, when is it a good time to be overweight on debt, and so on.
Okay.
So, for example, just to give an example, in our balanced advantage fund, we'll use a combination of earnings, market sentiment, and valuations as a combination to decide in a very methodical manner where you should be in that equity versus debt spectrum. So I think there are several of those advantages that come together which improve, adjusted risk return benefit to the client.
Right. So clearly diversification is the key mantra. But then, Vishal, what if someone is at a portfolio level, someone is already very well diversified. In spite of that, you think there is some place to have any category of hybrid fund in their portfolio. I'm already diversified. I have across market classes. I have diversified. I have debt in my portfolio. I have gold in my portfolio. Over and above that, do I really need a hybrid fund?
So I think there could be uses even with a very, very well diversified portfolio. I think one of the important things is how we behave when events happen. And very often you'll find that, greed and fear always tend to lead investor behavior. And what you therefore end up seeing very often is when equities are doing well, there is a tendency to want to go more overweight on equity, even though theory will tell us that we should be going underweight. And vice versa, when equities are cheap, we will keep waiting for them to become cheaper before we add allocation, even though we should probably be doing the opposite. So clearly that behavioral aspect gets well covered by hybrids because a lot of this happens in an automated manner.
Right.
Maybe there's a model, maybe there's just an asset allocation which is static, all of that comes in. The other place where this could find an opportunity is, say, for example, arbitrage funds. For people who are in the high tax bracket, they could find that if they have short-term monies, and when I say short-term, I'm talking about 3 months, 6 months, 12 months sort of money, not really a few days, they could actually evaluate using arbitrage because there is a tax advantage very clearly available on arbitrage where you can get taxed at equity rates instead of debt rates. So I think there could still be place for some of these hybrid instruments for investors. But clearly, if you're well diversified, I think the opportunity is lesser as compared to someone who's very well diversified.
So, Mansi, let's also focus on the risk involved in different asset classes and how it gets mitigated through different categories of hybrid mutual funds.
So see, volatility is a given. And especially in short periods of time, you could see drawdowns even in fixed income. Let's be clear that you can see that an NAV of a fixed income fund going below par. So what asset allocation does or what diversification does is that we have seen over a long period of time, there is very little correlation between active equity and active debt in India. And hence, you could benefit if your holding period is long enough. So you could reduce the volatility of your portfolio using this framework, either whether it is just fixed asset allocation or whether it is dynamic, as Gaurav was mentioning. So a lot of it comes from the low correlation, and we have seen certain indices that say a composite bond index versus the Nifty, which we have studied for over a dozen years, for which data is available. The correlation could be as less as 20%.
Okay.
So, which is a powerful tool in terms of diversification within your investment portfolio. So, yeah, volatility, yes. Diversification will at least reduce that.
Talking about the role of security selection, how is that important? How does it play well for your portfolio, and especially when in volatile times?
I think very interesting question, because so far we've just focused on the asset allocation piece, and I think in general people tend to look at hybrid funds as just asset allocation funds. But I think what goes on in terms of actual fund management is there are two more layers involved apart from deciding how much debt, how much equity. First, within each of those asset classes, you have to take these sort of broader thematic calls, right? For example, is this the right environment within equities to be more towards small caps or more towards large caps? Okay. Or for that matter, there are some market situations when certainly quality stocks start to do well. Last year, value stocks did well. So should you be in quality? Should you be in value? Sectorally, what sectors should you be in? Similarly, there's a challenge on the debt side also, whether you should be, taking more risk on credit today, taking more risk on duration and whatnot. So I think there is this second layer apart from asset allocation, which is, what we call thematic allocation, which also plays a role in terms of identifying the actual security. And then the final stage obviously is bottom up on securities themselves, which is deciding the right securities. So I think all three of these have some role to play in terms of shaping up eventual investor risk return.
Talking about goal alignment, because that came up earlier in the discussion also. How can one strategically place a hybrid fund, align them with a particular goal?
So I think one is, of course, solution-oriented products itself, which specifically work towards an end objective, whether it's retirement, education, etc. So retirement category, obviously, which a lot of people talk about saving for. I think they keep struggling with finding how do I actually do it. Yeah. And obviously, mutual funds do give you that option through the sort of hybrid structure to make that happen. Mm-hmm. Similarly, with education for children, a category which I think a lot of people are very passionate about saving for, and I think that passion's only increased over a period of time. Mm-hmm. So I think both of these categories, you can actually use products that are available, which are defined towards their end objective. And I think how it helps investors very often is, let's say you want to buy a house, right? Everyone wants to upgrade that house to just a little more space.
Right.
And what ends up happening is if all your money is sort of open, then you keep looking for how do I get that little bit extra without taking maybe a loan. And you maybe pull out money from one bucket, which was meant for another goal, and actually put into your house goal. Now, what a solution product does is it stays there reminding you, this is my retirement money. I'm not going to touch it for my house. Or this is the education money which I'm not going to touch for this house transaction. So I think that's where there could be ready-made solutions, which a lot of investors say, I just buy it, and the fund manager does the rest of the job, does asset allocation, and I sort of just let the money be there. There are exit loads which are built in to prevent people from taking the money out quickly, etc. So I think there are, that's one way to use this. The other way to use it is really to say, let's say I have long-term goals. One of the things I worry about is I don't understand market timing. I don't know when to increase equity, when to decrease equity, etc. Can I give it to a professional, let that person run a dynamic model, for example? The fund manager decides securities, decides the allocation, and let that take place. Or even if I want to go very long term, I might still be a little uncomfortable with putting all my money to equity. And therefore, I might like an aggressive hybrid instrument saying that 65 to 80% I'm okay with, because when events happen which are temporarily nasty, the lower drawdown is something I might be comfortable with. So I think you can use many of these solutions differently to take care of financial goals that you might have.
Mansi, what about fixed income, specifically conservative investors who are risk averse? How can hybrid be a fantastic fund category for them?
So fixed income in hybrid funds is generally actively managed. So you take bottom-up calls on the credits, like we do stock selection for equity. So we take bottom-up calls for credit selection, and then there is a lot of macro input which goes in deciding the duration, or which is the interest rate risk. So all that combines into a fixed income portfolio. As I said, there could be short-term volatility, but over a medium term, the accrual, just the interest getting accumulated, the coupons getting reinvested, would give you a corpus which would be very different from, say, a short-end savings product. Combine this with, as I said, conservative investors, you could just add a fund which is only, say, up to 25% equity. At least you should be targeting beating inflation. So, just don't look at only savings product, because what you really forget is like inflation eats away all your consumption power over a period of time.
In the current scenario, if at all someone wants to diversify their portfolio and in terms of their asset allocation also, what category would you recommend, and what should be their expected time of investment, the time that they should stay put in that particular investment, and maybe the expectation in terms of returns?
Right. So, difficult question, because again, as I said earlier, it all boils down to your individual risk return circumstances.
Totally.
But if I were to take paint everything or everyone from a single brush, then I would say a category like a balanced advantage fund category fits that bill well, because the asset allocation happens dynamically through predefined frameworks. Most importantly, these frameworks focus on, doing a counter-cyclical approach to investing. So you buy...
How is that?
You buy equities, for example, when valuations are cheap, when everyone else is throwing... So in a way, just like you buy stuff when they are on sale, here also you start buying assets when they are on sale, when everyone is sort of throwing them away at relatively attractive prices. And the same thing, you do when on other assets like debt as well, right? So when things are looking bleak and when expected return is high and current valuations are low, you move to debt and so on, right? So I think that automatically happens through a dynamic, through a balanced advantage fund in a dynamic fashion, and that allows you both the diversification benefit as well as a bit of clever market timing, if I can use that word.
Right. So I think we've clearly established that a lot depends on your particular portfolio, the kind of goals you have and the kind of time horizon you want to stay invested in this particular category. But then what about senior citizen who might just want to take some risk in equity and might also want this to be a part of their regular income? Can this category be used?
Certainly. I think, I think somewhere a lot of senior citizens believe that, their working life is going to be much longer than their retired life. And actually, that's not what data is now showing. With life expectancy going up, very often retirement will be maybe longer than the time that you worked. And therefore, beating inflation is so important for this segment of people. And, just doing simple mathematics, saying, what, I have a corpus of X, if I get 7% a year, for the rest of my life I'm taken care of, really is not going to solve for them. And on top of that, healthcare inflation is a different challenge that they have to deal with. So very clearly, I think, investors, even in that category, need to look at some equity exposure. And therefore, the way that they can build it out is either through using things like conservative hybrids, or equity savings as well, where there could be, some equity in there basis a particular mix. Or they could say that, I'll have a core of my money lying in debt. Maybe it's debt mutual funds, maybe it's other debt instruments. And I'm going to supplement this with some aggressive hybrid or balanced advantage funds on top of that. Now, whether I want to use some of this also with a withdrawal facility so that I can actually create a cash flow for myself through a systematic withdrawal plan is a very, very powerful tool that is available for mutual fund investors. I think the concept of SIPs have got very well understood. Somewhere SWPs is still as a concept hasn't got that same attention. And I think for retired portfolios, SWPs can be very, very powerful because they're very tax efficient. They give you a regular source of income and they can also be inflation adjusting at the same time.
Last question, my time is almost up, but I want to understand the taxation that's there on the hybrid category.
So it depends on the category. I think what some of the instruments are doing, for example, those which use arbitrage instruments like dynamic asset allocation funds, equity savings, etc., and the aggressive hybrid, is they're treated exactly like equity, which means that if you're holding for up to 1 year, you'll get taxed at 15%. If you're holding beyond 12 months, you'll be taxed at 10% with a 100,000 rupee limit at which there is zero tax. For products which are more debt-oriented, if you sell before 3 years, it's going to be taxed at your marginal tax rate. So there are, again, the way to look at tax on this is it's not the reason why you buy them. It's a secondary benefit. But I think it's important that these could be sort of important decision parameters as well.
All right. So hybrid as a category, every investor gets something or the other, provided that you know what is your risk appetite, you know what is the time horizon that you want to stay invested in. And obviously, if it's goal aligned, the category will give you the maximum benefit. Thank you so much for being on the show today. And that will be all. Thank you so much for watching.